National Health Investors delivered a mixed Q2 2026 report today. They beat heavily on headline earnings per share, but completely missed on revenue and core operating metrics.
Right. The revenue came in at $68.9 million, which missed the $71.52 million estimate.
Yeah, that is a 3.7% miss. It actually represents a roughly 22% year-over-year decline.
But then you look at the EPS, and they reported $1.15 per share. I mean, that absolutely crushed the 84 to 87 cent consensus estimate. That's a 32% beat.
It's massive. But then, full year 2026 FFO guidance was set at $4.74 to $4.79, which came in below the analyst consensus of $4.87.
So the market was clearly skeptical. Shares fell roughly 1.5% following the report, closing at $74.15.
Exactly. So we were taking the analyst notes, the earnings transcripts, and the press releases to really understand why a massive earnings beat resulted in a stock drop.
Right, and we're going to analyze NHI's pretty aggressive high-stakes pivot from being a passive landlord to an active senior housing operator.
Right. So looking at those numbers we just read off, an EPS beat of over 30% usually looks like a blowout quarter on paper. Why the negative reaction?
Well, we really need to pull back the curtain on the accounting here. The accounting completely distorts the operational reality in this specific case.
How so?
So that $1.15 earnings per share figure looks fantastic on a screener, right? But when you look at the underlying GAAP accounting, you see it was heavily inflated by a one-time $22 million gain on real estate sales.
Wait, $22 million just from selling buildings?
Yeah. They sold 5 properties for net proceeds of roughly $98.5 million. And under standard accounting rules, that massive gain gets legally dropped right into the net income bucket.
Oh, wow.
Right, so it artificially spikes the EPS for this quarter. It's not recurring revenue.
Okay, let's unpack this for you. It's basically like selling your car to pay your rent.
Yeah, exactly.
It makes your bank account look amazing this month, but your actual recurring salary hasn't gone up at all.
That analogy hits the nail on the head. And it points to why financial analysts who evaluate real estate investment trusts or REITs usually just ignore net income and EPS altogether.
Right, because real estate has that unique accounting quirk.
Exactly. On a ledger, a building depreciates over time, which legally lowers your net income. But in the real world, that building might actually be appreciating in value.
Which is counterintuitive.
It is. And conversely, a one-time asset sale spikes net income in a way that just isn't repeatable. That is why the industry relies on funds from operations.
FFO.
Right, FFO. It strips away all that noise, it adds back that non-cash depreciation, and pulls out those one-time sales gains.
So it gives you a true picture of the cash the core business is actually generating from its day-to-day operations.
Exactly.
So when we take out the car sale, so to speak, and just look at the recurring salary, what does NHI's FFO actually look like?
Well, it paints a much more stagnant picture. The NAREIT FFO, which is the baseline industry standard metric, was completely flat year over year at $1.19. Yeah, but the deeper concern is in the normalized FFO. This metric strips out even more transition costs to show the pure recurring core earnings.
And how did that look?
Normalized FFO actually slipped 2.5% down to $1.19. And that missed the analyst consensus of $1.26.
Which perfectly explains the market's cautious reaction today.
Yeah.
I mean, the core business, the day-to-day operation of renting out and managing healthcare facilities just isn't growing as fast as that headline profit suggests.
No, it's not.
You can't sustain a business or, long-term dividend growth by just selling off your assets quarter after quarter.
The accounting backs up your point entirely. The market recognized that the EPS beat was a byproduct of transactions, not a triumph of underlying operations.
Right.
But those real estate sales driving the EPS beat, they're actually part of a deliberate strategy. They're providing the essential capital for a massive company-altering structural transformation.
And this structural transformation really is the main story of NHI right now. On July 1st, so just after this quarter closed, NHI completed the sale of its 35-property NHC skilled nursing portfolio.
An enormous transaction.
Yeah, they received $560 million in cash. And they're expecting to record a staggering $541.6 million gain in the third quarter. I mean, they are selling off a massive chunk of their historical foundation.
They are. And to understand why they would sell off such a huge part of their portfolio, we have to look at the historical model of a healthcare REIT and, why it's currently under pressure.
Right. The old way of doing things.
Exactly. For decades, the absolute gold standard in this industry was the triple net lease. Under a triple net lease, NHI simply owns the physical building.
Just the bricks and mortar.
Right. The operator who runs the nursing home pays the rent to NHI. But that operator is also entirely responsible for paying the property taxes, the insurance, the building maintenance.
So from NHI's perspective, it is an incredibly passive, predictable stream of income. You just sit back and let the rent checks roll in.
Yeah, exactly.
Without having to worry about, fixing a leaky roof or paying property taxes.
Precisely.
But clearly there is a flaw in that model if they're rushing to sell 35 of these properties.
Well, the flaw really lies in the regulatory environment. Those skilled nursing facilities rely heavily on government reimbursement, specifically Medicare and Medicaid.
Government funding.
Right. That means the operators paying rent to NHI are constantly squeezed. Government reimbursement rates often stay flat or barely rise, but the operators are facing exploding real-world costs.
Especially labor, right? I mean, nursing wages have absolutely skyrocketed recently.
They have. So when an operator's margins get squeezed so tightly by government policy that they risk bankruptcy, well, NHI's reliable rent check is suddenly in jeopardy.
That makes total sense. If your tenant can't make a profit because Medicaid isn't paying them enough to cover their nurses' salaries, they can't pay you rent.
Exactly.
So NHI is looking at this dynamic and deciding to just completely exit the government reimbursement game.
That is the strategic pivot. They are taking that $560 million in cash from the skilled nursing sale and moving aggressively into private pay senior housing operating properties.
The industry shorthand for this is SHLP, right?
Yes, SHLP. These are independent living, assisted living, and memory care facilities. The key difference here is the residents pay out of their own pockets or through private insurance.
So there is zero reliance on Medicare or Medicaid.
Zero.
But they aren't just changing the type of buildings they own, right? I mean, they are fundamentally changing how they extract value from them.
Yeah, and this is where the risk profile changes dramatically. In the SHLP structure, NHI is no longer a passive triple net landlord. They're actively operating the business.
Oh, wow. So they're actually running the facilities.
Well, they hire a specialized management company to handle the day-to-day staffing, but NHI shares directly in the underlying revenues and the operating expenses of the facility.
So if the facility is fully occupied and resident fees increase, NHI captures that upside directly.
Exactly. But if labor costs spike, or if the building sits half empty because, a competitor opened across the street, NHI eats the financial loss.
To put that in perspective for you, it is like switching from being the landlord of a restaurant building to suddenly being the owner of the restaurant itself.
That's a great way to think about it.
Before, you just collected a flat check every month, regardless of how many burgers they sold. Now you have to pay the chef, manage the food supplier, run the marketing, and take the hit if nobody shows up for dinner on a Tuesday.
That captures the shift perfectly. They are trading the relative safety of passive rent collection for a higher risk, higher reward operational model.
And the speed of this transition is staggering. A year ago, these SHIP assets made up just 5% of their total portfolio.
Right.
Today, it's 24%. And management has publicly stated their target is to push that to 40 or 50% of the portfolio in the next 3 years.
Which is incredibly aggressive.
So they're basically betting the future of the entire company on their ability to actually run these private pay facilities. Which means we really need to look closely at how this specific segment is performing right now.
We do.
Because if segment revenue is booming, great. But if they are struggling to operate the restaurants they already own, buying 100 more seems incredibly risky.
Well, when you look at the top-line numbers for the SHP segment, they actually look incredibly strong.
Oh, really?
Yeah. Total SHP net operating income, or NOI, exploded by 188.5% year over year to hit $11 million.
Wait, if overall segment revenue exploded by nearly 190%, that sounds like a massive success.
It sounds like it, yeah.
But how much of that is actual operational improvement versus just buying new revenue?
Almost all of it is just buying new revenue.
Oh, I see.
Yeah, that 188.5% surge was driven almost entirely by the acquisition of 27 new properties.
Yeah.
When you buy a bunch of existing businesses, your total aggregate revenue naturally goes up.
Right, obviously.
Yeah.
So how do we see the real picture?
To gauge the true operational health of the strategy, analysts have to look at the same store metrics. This isolates the 15 SHLP properties that NHI has owned and operated for more than a year, which removes the noise of the new acquisitions.
And when we look at those older, established properties, the story gets a bit concerning. For those 15 same-store properties, the net operating income actually declined 6.2% year over year.
Yeah, the underlying metrics really explain why that decline happened. Same-store occupancy dropped 400 basis points year over year, falling to 85.8%.
Wow, so they're losing tenants.
Basically. Now, management did manage to increase the revenue per occupied room, a metric called Rev POR, by 3.8%.
But raising prices on existing residents wasn't enough to offset the financial drag of having fewer filled beds.
Exactly. Consequently, overall SHOP margins shrank by 250 basis points, dropping down to 24.6%.
Raising prices while losing overall occupancy is a classic symptom of transitional friction. And it gets more complicated when you look at the corporate costs required to run this new model.
The overhead.
Yeah. General and administrative expenses, the G&A, surged 44% to $8.8 million. I mean, why does moving from triple net to SEFP require an almost $9 million spike in administrative costs?
Because being an active operator requires a massive corporate infrastructure that a passive landlord simply doesn't need.
Right.
When you are just collecting triple net rent checks, you need a lean team of financial underwriters and accountants. But when you transition to the SHOP model, NHI suddenly has to build out internal human resources departments to oversee nursing compliance.
Oh, sure.
They need regional marketing directors to figure out why beds are sitting empty. They need operations analysts auditing food costs across multiple facilities.
So that 44% surge in G&A is just the cost of building the corporate machinery required to run a hospitality and healthcare business.
Exactly, it's structural.
But here is where I have to push back on management strategy. If your existing same-store operating properties are losing occupancy and your operating margins are shrinking, and you just had to spike your administrative overhead by 44% to build this new infrastructure,
I know where you're going with this.
why double down and buy hundreds of millions of dollars more of these properties right now? Isn't that just multiplying an unprofitable equation?
Well, analysts pressed management on that exact contradiction during the earnings call. Management's defense is that we are observing the company in the messy middle of the transition.
A messy middle.
Yeah. Their argument is that when you purchase a portfolio of underperforming or struggling properties and transition them to new local operators, there is an inevitable period of disruption.
Makes sense.
You're dealing with staff turnover, physical renovations to the buildings, and overhauling local marketing strategies. Occupancy naturally dips during that renovation phase before it recovers.
So they're saying it gets worse before it gets better?
Right. And to back this up, management pointed out that while same-store NOI was down year over year, it actually increased almost 19% sequentially from the first quarter to the second quarter of this year.
Okay, so they are arguing that the year-over-year decline reflects the bottom of the renovation curve, and the sequential growth from Q1 to Q2 proves that their turnaround strategy is finally starting to take hold.
Yes, the data supports that sequential recovery narrative. And regarding that massive spike in G&A costs, CEO Eric Mendelsohn addressed it directly.
What did he say?
He stated they are deliberately investing ahead of their growth. They are spending the money now to build out the technology, the compliance frameworks, and the personnel.
So that when the portfolio reaches that 50% SHIP target, the infrastructure is already in place.
Exactly. It won't collapse under the weight of the new acquisitions.
But paying for that massive operational infrastructure requires serious expertise. They clearly know the market is watching this transition with a healthy dose of skepticism. How is management proving they actually know how to run these facilities?
Well, the clearest signal that management understands the unique demands of the SOP model is their most recent executive hire. They just appointed their first ever Chief Operating Officer, Chris Mangett.
Wait, their first ever. Up until now, NHI operated more like a specialized bank, right? They underwrote real estate loans, managed leases, and collected rent.
Yeah.
The fact that they never had a COO before speaks volumes.
It really highlights a complete cultural shift. A Chief Operating Officer in this context isn't sitting in a boardroom looking at spreadsheets. Mangett brings deep, ground-level operational experience in senior housing.
So what does his day-to-day actually look like?
Well, a COO's job is to fly out to a struggling facility, evaluate the nursing staff rotation, audit the local marketing spend to see why move-ins are down, and ensure clinical compliance with health regulations.
That's a completely different skill set.
Completely. Having someone solely focused on integrating these properties does two things. First, it brings necessary hospitality and healthcare expertise in-house. Second, it completely frees up their Chief Investment Officer, Kevin Pascoe, to focus entirely on deploying capital and sourcing new acquisitions.
And that capital deployment is critical right now because NHI is sitting on a mountain of cash from that NHC skilled nursing sale.
A huge mountain.
Yeah, they used some of the initial proceeds to pay down existing debt, but they still have $334 million remaining. Managing that cash pile is actually incredibly complicated for a REIT.
It is a high-stakes balancing act, mainly driven by tax law. Because NHI is structured as a real estate investment trust, the IRS requires them to distribute at least 90% of their taxable income to shareholders every year.
Right, that is the trade-off for not paying corporate income tax.
Exactly. So when NHI generates a massive $541 million gain on the sale of those skilled nursing properties, that counts as taxable income.
Oh, wow.
If they just hold that cash in the bank, they might be legally forced by the IRS to pay it out to shareholders as a massive one-time special dividend to satisfy that 90% rule.
Now, if you are a retail investor, a special dividend sounds fantastic. A huge, unexpected cash payout just for holding the stock. But why is NHI management working so hard to avoid paying it?
Because while a special dividend temporarily thrills investors, it permanently drains the company of the capital it needs to grow.
Right.
Management wants to take that $334 million and use it to acquire more private pay SI shop properties, which will generate recurring monthly income for the next 20 years.
If they pay it out as a special dividend, the capital base shrinks, and their ability to grow future earnings disappears.
Exactly. To legally avoid paying that special dividend, they have to utilize a specific mechanism in the tax code known as a 1031 exchange.
Let's walk through how a 1031 exchange actually works in practice, because it places an enormous amount of pressure on the company.
It really does. Section 131 of the IRS tax code essentially allows a real estate investor to defer all capital gains taxes on a sale, provided they take the proceeds and reinvest them into a like-kind property.
Okay.
However, the IRS imposes a ruthless ticking clock. From the day the sale closes, NHI has exactly 45 days to officially identify potential replacement properties they want to buy.
Just 45 days.
Yep, and only 180 days to actually close the deals.
So NHI is racing against a literal countdown timer to find $334 million worth of high-quality senior housing.
That's right.
That creates a huge risk of buying bad assets just to meet a tax deadline. I mean, if you have 45 days to identify a massive portfolio, you might overpay or skip essential due diligence just to avoid the IRS penalty.
Analysts zeroed in on that exact risk on the call, but management stated firmly that they will not sacrifice their underwriting discipline just to dodge a tax bill.
Good to hear. What's the backup plan then?
If they cannot find $334 million worth of high-quality SHOP acquisitions that meet their return metrics within the time limit, they have fallback plans.
Like what?
They can use the cash to pay down more debt. They've actually already noted they plan to retire a $100 million private placement note by the end of 2026. Or, as a last resort, they will simply bite the bullet and pay the special dividend to shareholders.
The fact that they have the flexibility to pay down debt really speaks to the overall health of their balance sheet. Despite the friction of this transition, they are operating from a position of financial strength.
Yeah, really.
I mean, their consolidated net debt to adjusted EBITDA is sitting at 4.1 times. That's right in the middle of their target leverage range of 3.5 to 4.5 times.
And furthermore, they have almost $800 million in available liquidity between cash and revolving credit facilities.
That strong balance sheet is what allows them to utilize what we might call a financial pacifier for their shareholders.
A pacifier, yeah.
Major structural transitions take time. We just saw that the same store operational metrics might look ugly for another quarter or two while they renovate and stabilize these new SHOP properties.
Right.
So to reward investors for their patience and keep them from selling off the stock during this messy phase, the board raised the quarterly dividend by 2 cents to 94 cents a share.
And that dividend hike locks in a roughly 5% annual yield. Essentially, management is paying investors a 5% yield to wait while they rebuild the company's operating structure.
It is a highly pragmatic move. A reliable 5% yield establishes a strong floor under the stock price.
It does. It signals to income-focused investors that the transition is fully funded, the checks will continue to clear, and they are actually getting a raise.
Right.
This strategy buys management the crucial runway they need to execute the operational turnaround of these SHOP properties without facing a shareholder revolt over near-term, messy earnings metrics.
Okay, let's pull all of this together. We started with a company that beat Wall Street earnings estimates by over 30%, only to watch its stock price fall.
Yeah.
When we peeled back the accounting layers, we saw that the core FFO was actually slightly down, and the massive EPS beat was simply a one-time gain from selling real estate.
Right.
But that $560 million sale of government-dependent skilled nursing facilities is the fuel for a total corporate transformation. NHI is aggressively abandoning the passive triple net lease model and using the cash to buy private pay, senior housing operating properties, transforming themselves into active healthcare operators.
And right now, they are deep in the frictional phase of that transition. They are seeing their administrative overhead spike by 44% as they build out an internal operating infrastructure.
Exactly.
And their older properties are experiencing slight occupancy declines as they renovate and integrate, but they are fortifying the balance sheet, bringing in dedicated operational leadership like a new COO, and maintaining a 5% dividend to keep their investor base anchored while the strategy plays out.
Which leaves us with a final provocative thought regarding the macro environment NHI is attempting to capture.
Yeah.
The very first of the baby boomer generation turns 80 years old this year.
Oh, wow.
Yeah, we're standing at the absolute precipice of an unprecedented demographic tidal wave for senior housing.
We really are.
The sheer volume of demand over the next decade is going to be staggering, especially considering that new construction of these facilities is currently at historic lows due to high interest rates.
The supply and demand fundamentals for senior housing have almost never looked better. I mean, it is one of the strongest demographic tailwinds in the entire real estate sector.
So the question isn't whether the senior housing market will boom.
Yeah.
It absolutely will. The real question is whether NHI's massive gamble to abandon the safety of passive rent collection will actually pay off.
Right.
Will becoming an active, hands-on operator allow them to capture the exponential financial upside of this aging population? Or will the brutal day-to-day complexities of hiring nurses, managing inflation, maintaining clinical compliance, and running these facilities ultimately eat away at the profits that a passive landlord would have simply sat back and collected?
The transition from owning the real estate to running the business is never seamless. The financial reports rarely show a straight line of success. The transition risks, the administrative build-out, and the strategic pivot, that is where the actual future of the company is being decided, far beneath the headline earnings numbers.
And navigating those underlying mechanics is exactly why we break these reports down. To keep cutting through the noise and understand what is actually driving the market, make sure you follow this show for our daily, no-nonsense earnings coverage. We will see you next time.